Hi, my name is Aubrey Hearn, and I want to provide you with an update on the Sentry US Monthly Income Fund. We are emerging from a year that saw the steepest economic decline in the US since government started to keep records. The path to recovery is centered around a few currently approved vaccines with potentially more to come. Although the US indices have generally fully recovered, the leadership is narrow, and there are pockets of the market that are poised to catch up. As bottom-up investors, we make investment decisions on a company-specific basis. However, in general, we are positioning our portfolios to benefit from a return to normal. Within this theme, we remain focused on companies with structural tailwinds that can compound capital over time. It is likely some businesses may never fully recover due to changes in consumer behavior. We look to avoid these types of businesses despite very attractive valuations in many cases. Risks remain whether it's another wave of rising COVID cases, ineffective rollout of vaccines, looming debt, tax hikes, and as a result, we are comfortable with approximately 34% allocation to fixed income and 66% allocation to equities in the fund. Two companies that we believe to be attractive within our investment framework are Boston Scientific. Boston Scientific develops and manufactures minimally invasive medical devices. Hospitals faced shutdowns and reduced capacity in 2020. During peak lockdowns in the second quarter, revenue dropped by 29%. Most of these procedures have been deferred as opposed to canceled due to their non-discretionary nature, such as changing of a pacemaker. As such, we believe that once restrictions are removed, they should be able to grow above the historical mid-single-digit growth rate for an extended period of time. The second company is Sensata Technologies. Sensata manufactures auto sensors. As vehicles and electronics become more complex, they require more sensors. This creates a natural tailwind for Sensata to grow at a rate faster than underlying production. In general, most of Sensata's end markets have seen demand outpace supply in 2020. This is predominantly due to plant shutdowns that occurred in the second quarter due to government mandates. During that time, Sensata significantly reduced costs. We expect once restrictions are lifted, these industries will begin to produce above demand as inventories are very low. We continue to expect elevated cases of COVID-19 and slowing economic growth in the first half of the year. However, once herd immunity has been reached following widespread vaccination, we should see a rapid snapback. Driving factors of an improving economy and corporate profit include elevated consumer savings, higher corporate margins following significant cost restructuring, and record low interest rates and easily available liquidity. Despite being cognizant of certain pockets of the market that seem extremely overvalued to us, we still see many attractive areas to invest in. Equities are still of great value to us, especially relative to other asset classes, and we remain an overweight to equities in the fund. Thank you.